interest only or a repayment mortgage. Which one would be most suitable for you? Hi, if we haven't met before, my name's Dan and I'm a CeMAP qualified mortgage and protection advisor. This video is purely for educational purposes only and should not be seen as advice or a recommendation to act. And I must stress, your home may be repossessed if you do not keep up with the repayments on the mortgage. With that out of the way, on with the video. The two main ways to pay a mortgage are interest only and repayment, also known as capital repayment. In this video, I will hopefully give you the basics to help you decide which one is most suitable for you. But I do strongly recommend you speak to a qualified mortgage advisor such as myself before making this decision. So what is an interest-only mortgage? Your monthly repayments only go towards the interest on your mortgage. This means you will not be reducing the balance of the mortgage. The repayments will be lower each month, but you will still owe the same amount at the end of the term as when you initially took out the mortgage. You will need to repay the whole balance at the end of the mortgage term to own the property fully. You can do this in several ways. You can use a repayment vehicle, such as any kind of savings plan like an ISA, investment fund or pension. You can use a lump sum that you get before the mortgage ends, such as inheritance or a pension withdrawal. You could also choose to sell the property to pay back what you owe to the lender. Now, whilst some of these might be the ways you can actually pay back the capital to the lender at the end of the mortgage term, they aren't necessarily all acceptable, so you will need to check with the mortgage lender before applying. So what is a repayment mortgage? With a repayment mortgage, when you make the monthly mortgage payments, part of the payment goes towards clearing some of the mortgage balance, as well as paying the interest. The amount you pay each month is calculated so that you pay off the full amount owed by the end of the mortgage term. Mortgage terms typically range between 5 years to 40 years, and the maximum term available to you depends on your age and also whether you have acceptable income to support the mortgage into your retirement. I must stress that the longer the term of the mortgage, the more interest you'll pay back, and this applies to both interest only and repayment mortgages. One of the benefits of a repayment mortgage is you will own the property outright at the end of the mortgage term. So which is better, interest only or repayment? This entirely depends on you and your circumstances and your needs. The advantages of repayment mortgages are pay less interest overall because of what you owe decreases every month. Towards the end of the mortgage term, more of each payment goes towards clearing the balance. Another benefit is you may have the option to apply for lower interest rates later in the mortgage term because there can be cheaper rates available once your outstanding balance is smaller. However, I may add that for the majority of lenders, once your loan to value drops anywhere below 50 or 60%, then the rates will remain the same. You will also own your home at the end of the mortgage term if you make all of your repayments. However, a negative can be the monthly repayments will be higher than if you get an interest-only mortgage, so make sure you'll be able to afford them. The advantages of interest-only mortgages are lower monthly payments because they only cover the interest. More flexibility to choose where your money goes. You can decide how you will save to pay back the mortgage balance, and you could make a profit if your investments perform well, as you could save enough to pay off your mortgage more quickly. The disadvantages of interest-only mortgages are it's usually more expensive overall because the amount you owe will not decrease over the mortgage term. This means that the amount of interest you pay will not go down either unless you get a deal with a lower interest rate. They can be more complicated to look after because your mortgage and repayment vehicle may be separate. They're also riskier than repayment mortgages if your repayment vehicle performs badly, because if your repayment vehicle relies on investments, pension funds, an inheritance, or a rise in house prices, it may not make enough to pay off your mortgage. So which is the cheapest? As I've already mentioned, repayment mortgages typically cost less overall, but come with higher repayments compared to interest-only mortgages. For example, if you took a mortgage for $160,000 at 4% for 25 years, the monthly payment is around £843 per month on a repayment mortgage, but around £533 a month on interest only. On interest only, you will pay back £159,999 in interest over the 25 years with a 4% rate and owe the original £160,000 that you borrowed, which means you would pay back £399,999. With a repayment mortgage, you pay around £253,124 in total, of which £93,124 is interest, with the remaining £160,000 being capital that you owed. Choosing which one is right for you. Interest-only mortgages do not suit most borrowers. Only get one if you're aware of the risks and have a repayment plan to save enough capital by the end of the term. You would need to be able to make a profit from your investment vehicle and preferably have a backup option to help you pay off the mortgage. You can get a mortgage split between repayment and interest only, which is also known as part and part. This is where part of your mortgage balance is on interest only basis and the other part is on capital payment with an element of interest. Your balance will go down every month, but there is still an amount left to pay at the end of the mortgage term on part of the mortgage that you have on interest only. Interest-only mortgages can be complicated and also difficult to obtain if you're applying for a mortgage on a residential property. This is why I would strongly recommend you speak to a mortgage advisor before opting for an interest-only mortgage. You need to think carefully before securing other debts against your home. Your home may be repossessed if you do not keep up with the repayments on your mortgage or any other debt secured on it. I appreciate that is a lot of information to take in. Please feel free to ask me any questions in the comments below. If you would like my help to obtain a mortgage, please feel free to get in contact with me. If you need to know more information on the differences between all the interest rates, please watch this video. And if you need to know about all the costs on obtaining a mortgage, please watch this video. Thanks for watching. See you next week.